What is going on, investors? Hopefully guys are doing well out there. Time for another sector review, and we've got a couple of these on tap. Today, we're going to look at the apparel industry, one stock that we've covered very frequently here on the channel. In fact, they report their earnings next week on September 29th. So today is effectively kind of a Nike's preview as well, but we're also going to be talking about Lululemon. We're going to talk about VF Corporation. We'll also talk about Under Armour as well. So certainly some opportunities in the apparel space. When we come over here and look at Nike, we'll take a look at the technical chart patterns. We'll take a step back actually with all of these stocks and maybe not look at it more in kind of the micro event or kind of the shorter term. We'll take a longer term perspective on a lot of these stocks. I think a lot of these stocks, quite frankly, when it comes to VF, Lulu, and Nike, there's some great opportunities with these stocks coming forth if they continue to pull back. So we'll talk about that. We'll go over the most recent earnings. When it comes to Nike, we'll talk you through Q1, which is the upcoming quarter next week on next Thursday. We'll talk you through some of the things that we're going to be looking for. We'll take a look at some of the revenue estimates, the valuations with these companies. Most of these stocks, in fact, all of these stocks have pulled back pretty heavily this year. So we'll talk about, is this a great opportunity to start accumulating some shares of this stock? Take a look at some of the more recent news with these as well. Now, we'll kick things off with Nike. Year to date, this stock down 37% over the last year. Similar story, down about 33%. But where things get rather exciting when it comes to Nike, you stretch it out to a 10-year view and you're up 30% a year for the last 10 years, up 333%. Max view, since the 1990s, you're up just 4,500%. So I know when you guys are watching CNBC, and I'm doing the same, they're talking about the 2-year and the 10-year and socking your money away and earning 4% over the next year, which doesn't factor in the fact that inflation's probably going to be higher than 4% over the next year. And so you're actually going to lose money. I tell you what, folks, this channel is not going to be for you if you want to sock your money away for a year, 2 years, 5 years, 10 years, and loan it to the government who got us into this mess. This channel won't be for you if you want to just curl up in a little ball and hide into a 2-year or a 4-year or a 5-year instrument and earn a couple percent on your money. This is not the channel for you. The people that are doing that are money managers that are managing millionaires and billionaires' money. If I was managing millionaires and billionaires' money who had already made it in this life, already made a bunch of money, already have a very successful lifestyle and a house, well, I tell you what, I probably would be socking my money away and making 4%. But chances are the vast majority, in fact, I would gauge almost everybody watching a video like this, you haven't made it yet. You haven't bought your yacht. You haven't bought your multi-million-dollar house. You haven't bought your vacation home. I tell you what, folks, none of those things are going to happen if you sock your money away in a 2-year instrument over the next 2 years. You're going to lose money to inflation, and you're going to be 2 years later have the same amount of wealth that you do today. If you want to grow your wealth over the next couple of years, particularly over the next 5 to 10 years, and you want to transform your lifestyle, you need to be aggressive and you need to take some big risk. And some of these stocks, I think, are well suited for that. When it comes to Nike, you do get a yield on this one, okay? About a 1.19% yield at the current time. Obviously, this stock continues to pull back. You get more of a yield. If you hold this stock, I have held this stock for over 10 years. I'm getting well north of probably a 5, 6, 7% yield at this time. I think when I first bought this stock, it was at a 4 or 5% yield, believe it or not. And it just continues to grow year over year. So on that initial investment, I'm getting tremendous yield. That is what you invest in for yield, because not only have I earned 30% on my money, but I'm also earning, I think the last time I looked at this, I'm earning like 6% on my original investment when it comes to Nike. That is the type of move that you need to make when everybody else, like millionaires and billionaires, are crawling out of this market. That's when you need to make your move. And a stock like Nike, probably well suited for that. Now, they are seeing some downgrades from Barclays. I saw a few others come in this week. They're talking about the fact that when we come over here and look at the revenue estimates, this stock is basically flatlined. And I don't think there's a lot of people believing the Q1, Q2, basically into 2023 and 2024, the fact that Wall Street has this stock accelerating kind of to a low double digit, maybe a high single digit grower. In the most upcoming quarter, again, this is the quarter Q1 for Nike, which we should see report on Thursday, September 29th, analysts are expecting $12.3 billion worth of revenue. In the most recent quarter, we had about $12.3 billion. So on a quarter over quarter basis, this stock has basically gone flat from a revenue perspective, but also on a year over year perspective, we're also flat there. Some of that has to do with the stronger dollar, the fact that this is a multinational company and you have the strength in the US dollar. We'll see evidence of that when we go through the different geographical regions that Nike sells into. We've seen tremendous FX impact when it comes to the revenues and certainly profits when it comes to this company. Now, for the Q2, which includes a little bit of holiday shopping season that ends in November of 2022, we're expecting just $12.1 billion. That would represent about 7% growth. Obviously, we'll have a little bit more read next week if this is possible. Now, what I don't necessarily think is possible, and this is not only goes for Nike, but for a lot of stocks, somehow this stock is going to reaccelerate in its February Q3. This is 2023, which would be a Q3 for Nike, somehow going to grow 11% year over year. And then thereafter, kind of between 10 and 11% for the end of when analysts are analyzing this company. And that is the risk in the stock market right now, is that these analyst estimates are still too high. Most people believe, including myself, they'll probably have to get walked back a little bit. Certainly what's not priced into the stock, I don't think to a fully degree, is actually meeting these targets. So if Nike and a lot of stocks, quite frankly, if they can somehow magically reaccelerate their revenue growth, well, it could bring higher prices to a lot of these stocks. Now, from a valuation perspective, because this stock is down 30-something% this year, well, it has created a little bit better valuation over at Nike. You're trading, I've got a 10-year price to sales on this one. You're trading about 3.62 times trailing 12-month sales over at Nike. Now, obviously, it was wildly overvalued between 2020 and 2022. Like a lot of stocks, we weren't necessarily recommending buying this stock during that time frame. I certainly didn't, but it started to pull back. Now, I would say more kind of maybe a trailing 10-year average. You're probably south or right on 3 times sales would get me a little bit more excited at Nike. Now, in terms of the Q4 that they just reported, again, we're coming into fiscal quarter Q1 over at Nike next Thursday on the 29th. Last quarter, we had $12.2 billion. Again, Street is expecting basically the similar types of revenue. What's hurting Nike is obviously these margins have come under pressure as the cost of sales and the cost of goods, getting them shipped over here to the United States, not only getting them made as well, that's certainly impacting the cost of goods, those gross margins. The other thing that we're seeing rise is the demand creation expense. This is essentially marketing at Nike. That was up 6% year over year last quarter, and their overhead expenses, essentially employees and all the other back office that Nike needs to operate their business, that was up 8% year over year. So your gross profit actually slipped by 3%, so a negative 3% on those gross profits, and your expenses rose 8%. So that's a problem. That obliterated net income, not really obliterated, but your net income was down 5% year over year, from $1.5 billion down to about $1.44 billion. Now, they are buying back the stock over at Nike, so your EPS not really hurt that much, but I would pay attention in the upcoming quarter next week. Did revenues at least hold that $12.3 billion? If they were able to expand that up into, I would say probably north of 12.5, that would certainly be bullish for the stock. How are these gross margins? Can they maintain that 45-46% range? If they can do that over at Nike, I think we can come out of the other side of this with a really nice stock. And then obviously, how are they controlling their other expenses, their marketing and their overhead expenses? If those continue to climb, well, we should see net income and operating profits just continue to go down over at Nike. That could create some selling pressure on the stock. Now, company has plenty of cash. They do have some debt, but they have enough cash flow of this company. If they don't want to roll it over into kind of likely a higher interest rate, they certainly can do that. They have plenty of cash. They could pay off all of their debt with their cash. Now, they wouldn't have a lot of cash left, but they should be able to finance that with cash flows as well. Now, the one thing that we're going to focus on with a lot of these stocks is the inventory level, because obviously if you have a lot of inventory and it's a lot of inventory in the system and it's not selling, well, you're going to have to start doing discounting. So that's going to hurt obviously your top line revenue, but it also hurts your gross margins as well. As you start to discount products, well, that's going to hurt Nike. And look, the inventory over the last year, take a look, up 23% on this stock, from $6.8 billion worth of inventory last year all the way up to 8.4. We're going to see that across actually all of these stocks is inventory is up a lot. Now, for these individual stocks, not necessarily a good thing. For the macro economy at large, the fact that these stocks are probably going to have to pull back on pricing, not necessarily inflate them with the rest of the prices that we're seeing, probably good for that inflation number, as I don't think Nike or the rest of these retailers are going to be able to charge the type of prices that they might want to based on the inventory stacking. We'll certainly get updates on that next week. Now, the other thing that we talked about at the lead with the fact that you have this strong dollar, take a look at Europe, Middle East, and Africa. So your total revenues in that segment were up 9%, but if you factor in a flat dollar year over year compared to the currencies in these markets, well, you'd actually have been up 20%. So it's a dramatic, especially in Europe, you're seeing a dramatic decline year over year. Now, obviously those numbers start to lap each other, and that's certainly something that could turn into a tailwind down the road if the dollar weakens against the rest of these currency. But that's not necessarily, I think that's already priced into the stock. A strong dollar is probably priced into Nike stock a little bit, and some investors will give them a pass on the fact that revenues are being hurt by that strong dollar kind of weak euro trade. Now, what investors, including myself, are going to play. The fact, this is probably the first thing that I'm going to look at when it comes to the financials is the Greater China. Notice over the last year, Greater China down 19% on a constant currency basis, not nearly as dramatic as Europe. You're down 20% year over year. You went from 1.9 billion all the way down to 1.5. Obviously, with the shutdowns in China and all those types of things, looks like they're still there, right? I'm not expecting a great number here, and I don't think Wall Street is either. There could be some surprise to the upside when it comes to China, but I'm not necessarily expecting it, although I'm looking for maybe read through from management on if and when this gets better. Now, you've got APAC and Latin America as well. Look, up 15% year over year on terms of their revenue, but it would have been up 24% if you factored in a constant currency year over year. So Nike's kind of getting a double whammy. You have declining revenues in China, which is one of its larger markets, certainly from a growth rate perspective. And then you're having the two other markets, APAC and Europe, get slammed by the fact that you've got a strong dollar. Those are shorter term things, more than likely, maybe not China. You could talk about maybe a broader macro thing there where Nike's maybe fallen behind. I don't necessarily think that's the case, but you've got falling revenues in China and you've got falling revenues based on currency changes, or at least revenues not nearly as impressive as they would be if you factored in a constant currency. So a couple of double whammies for Nike. We're going to be looking for positive impacts on that, not necessarily in the upcoming quarter, but future quarters for this stock as well. Now, when we come over here and look at the stock chart, it's a thing of beauty. You can see why this is my number one holding outside of the tech stocks that we talk very frequently here on the channel about. This is my number one holding, and you can see why. Number one, you have a rising dividend every year, even despite kind of the falling numbers on this stock. You've got plenty of dividend coverage. Notice over the last 12 months, this company earned $3.75 per share, and I would expect that was a pretty rough year. Over the last 12 months was actually pretty rough for Nike, and the dividend is just $1.19 per share. So they've got plenty of room to continue to raise that dividend, probably north of 10% every year. You're actually keeping up inflation. So when you pour your money into the 2-year note, it's going to earn you 4%, and chances are if rates keep going down, the price of that bond is actually going to continue to go down. Whereas Nike, you're likely going to actually get a dividend yield raise every year that actually beats inflation. We'll certainly get an update on that later this year when it comes to Nike. Now, again, from a technical perspective, it has been locked in like a 30-year uptrend, probably like a 40-year uptrend. The stock, I mean, it just has not really broken trend over the course of its time. So I know there's a lot of investors out there that are saying, oh, this time's different. This time's different. Well, guys, I was invested in the stock market back here in the early 90s and the dot-com bubble. I was invested back here in 2008, 2009. Trust me, every time they tell you it's going to be different. With Nike, we're kind of sitting kind of in the middle of this range, maybe towards the low end. I tell you what, over the last 40 years, you've pulled back to this green trend line. And if we see that stock happen, you should go from about $100 per share down to about $80 per share. That's not much of a room. That's where I would accumulate these shares just a little bit, because again, the proof is in the the pudding here, guys. Every time we've pulled back to this longer term, very tight range on the stock, again, I'm looking at a monthly view of Nike. It has been a buy. And I tell you what, if it pulls back to that range next week due to poor earnings, I will step in and likely buy this one as well. Moving on to Lululemon. Now, this is a stock we may have covered it maybe once here on the channel, but a fascinating stock. Really like this company's products. And when you come over here to the financials with this company as well, you're going to see a lot of really good things here. I know the rub on Lulu, same with Nike as well. A lot of investors talk about how this stock and Nike are wildly overvalued compared to other retailers. Certainly when we look at VF Corp and we look at Under Armour, it certainly is compared to those two. But when we look at these financials, I mean, there's no other comparison other than really a Nike to Lulu. Now, over the last year, down just 24%. That's not that bad. There's actually bond funds that are down more than that. Year to date, this one's down just 18%. It's held up very nicely. You got a big market cap on this one, $42 billion. You don't get a dividend with this one, but they are executing on a buyback. Now, Jefferies came out last week and said that Lululemon's long-term targets are overly aggressive, and they reiterated a sell rating on this stock. I want to show you this company's longer-term trends. At least from their revenue perspective, the company is expected to actually grow 24% in the upcoming quarter, another 24% really in the fourth quarter, and then resume kind of a mid-teens growth rate all of next year, 2023, and even into 2024. You're going to get to nearly $3 billion worth of revenue by the end of 2024. We'll see if that's possible with this company. Certainly when we come over here and look at the company from a financial perspective, there's certainly some things to like, but there is your risk with Lulu. If it is not able to meet these revenue growth rates, well, I tell you what, this valuation is going to come in quite a bit. Now, the stock is and does have an elevated valuation, certainly compared to Nike, which a lot of investors think has an elevated valuation. Well, Lululemon is even higher. I've got a 10-year price to sales on this one, and we're still trading at 6 times on this one. So that to me basically insinuates that the market has to have this type of growth, not necessarily kind of mid-20s growth, but you better be able to maintain mid-teens growth with Lulu out into next year and probably into 2024 to maintain this type of valuation. 6 times sales on a retailer, certainly a clothing retailer, is rather rich. And you see, well, it's been much higher over the last couple of years, but it also has been much lower. In fact, it's been a Nike-like around 3 times sales. That's personally probably where I'd be attracted to this one. Now, in terms of their most recent earnings, they came out early September. You had revenue coming in at $1.87 billion. That was 29% growth. I don't know if every single investor out there is even paying attention to the fact that, yes, you'll have kind of low 20s growth for the upcoming quarters, but Wall Street's expecting it to actually slip down to a mid-teens grower. And whether or not that is priced into this stock at this time, I'm not exactly sure. Now, we'll come over here and look at the most recent quarter. You had nearly $1.9 billion. Last year, you had roughly $1.5 billion. What you love over this company is it has really high gross margins, Nike-like gross margins. You had just $812 million worth of cost. That left you with over $1 billion of gross profit. Their selling general administrative expenses, I tell you what, just $662 million over this company. Yes, it's up from $541 in the previous period, but that's not a lot of cost. And you see here, it led to a lot of income from operations. Off of this $1.9 billion worth of revenue, you had $1 billion worth of gross profit. You peel off another $662 million worth of cost, and you're left with income from operations sitting right at $400 million. Last year, you're at $291 million. You want to pull all the way down to net income, and you're earning $290 million off a nearly $1 billion, nearly $1.1 billion worth of gross profit. That is fantastic. If this company can maintain these growth rates, not necessarily the 29% they just posted, and not necessarily the 24% expected over the next couple of quarters, but if you could be in that kind of mid-teens, well, this company has an expense structure where they can absolutely nail those types of targets. Now, with this company, what we're also looking at, like we're looking at with all of these companies, is the fact that they have a boatload. I'm talking about a truckload of inventory at Lululemon. So I'm a little concerned, not necessarily from the revenue standpoint, but from the gross profit and the gross margin perspective. Look at these inventory build over the last year. You have over $510 million. This is our cash flow statement at Lululemon. In fact, last year we built up about $137 million worth of inventory. This year, 510. I actually want to zoom all the way up to the balance sheet. So here's our balance sheet at Lululemon. Here's that inventory line. Last year, 966, or actually this is the beginning of the year. That's why the cash flow number might be a little bit more comparable. But at the beginning of the year, you had 966. Now you got over 1.5, nearly $1.5 billion worth. Your cash has just been completely drained over this company, primarily because they poured it into inventory over the last year. You had about $1.3 billion worth of cash. Now you're just at $500 million worth of cash. But from a liability perspective, there's not a whole lot over here. So this company should be okay, more than okay from a financial perspective, but they have all this inventory. So it makes me a little bit concerned about how margins are going to be for the upcoming quarters. You see here over the last year from a cash, we're back on cash flows over the last year. So you pull down a net income number. This is for like a 6-month period. You earned $480 million. Last year, just $353. But notice the impact of building that inventory over the last year. You went from $500 million worth of positive cash flow from operating activities this year to a negative 145. So I tell you what, they better have a strong Q3 and Q4 at Lululemon if they want to generate positive cash flows. If they don't, they're going to have to cut and slash this inventory. Certainly that'll be good for you, the consumer, but bad for Lululemon from a stock perspective. Now, they are repurchasing the stock as well to the tune of over $357 million in the most recent period. Last year on a 6-month basis, they bought back $254 million. The challenge with Lulu in the upcoming quarters is how the demand is going to handle all of this excess inventory that the company has. I mean, it's way higher than where they were in a period ago. And if you believe the United States, quite frankly, around the world is going to slip into a recession, people are going to pull back on their discretionary spending. Well, they might trade down from $150 pair of leggings down to like a $20 pair that they can find at Walmart or Target or on Amazon. So Lulu is likely going to have to pull back on their pricing, their margins, their profitability going to come in. If you don't believe that's going to happen and they're still going to be able to charge $120, $130 for a pair of leggings, well, this company is probably pretty well positioned. Now, from a technical perspective, I'm looking at a monthly chart over at Lulu, and I basically, this is a really crude kind of analysis on this one, but we do have basically a chart going back from the February and March lows of 2009 when most stocks bottomed in the stock market, and we have been in a straight arrow up. When it's pulled back to this line just really 2 or 3 times since then, it actually has been a buy. And here we are sitting right here on top of this line. Now, if you come all the way down this line, you're actually about $275. That's another $40 or $50 lower than where the stock is today. So it necessarily wouldn't be a buy at the current time with Lulu, but this is an area where if you like Lulu and if you believe they're going to be able to move this inventory, not necessarily at full price, but very close to full price, well, this is an area where you can buy this one. It's not necessarily wildly undervalued when we come over here and look at from a price to sales basis, but it certainly has been more overvalued than this in the past. I really like Lulu, but I would like it probably at a little bit cheaper price with this one. I may take a stab at this one when it pulls back, which I think it probably will, but it would be one of those kind of higher risk investments because if the growth rate stalls and the inventory doesn't sell through, well, this one's probably heading much, much lower considering the valuation already in place on Lulu. Now, moving over to a more interesting stock, one that we haven't covered here on the channel, but this is a stock actually I followed privately on my own for many, many years. And it's always one that I kind of wanted to buy. And I tell you what, folks, over the last year, this thing is down nearly 50%. Over the last year, down 45%. Year to date, it is down 50%. I want to clear that up. We've got a over 5% yield on this one. I can't remember the last time I've looked at VF Corp and it's at a 5% yield on this one. You got a $15 billion market cap on this one. And certainly when we look at this from a valuation perspective, it looks really cool. Now, some of you might not know what VF Corp is. Essentially, it's a conglomerate of a lot of different brands. And most of you are probably very familiar with these brands like Vans, North Face, Timberland, Dickies, JanSport backpacks. More recently, they bought Supreme. This was a year or two ago. I think they spent a couple $2 billion on that. Now, the company just released their earnings, not just, but this was back in July. So they're likely coming up on their earnings date again. Revenue coming in at just $2.2 billion. So you're seeing why we focus. If I was going to focus on the apparel industry, I'm going to lean toward a Nike, which has way more earnings than this. And you grew at just 3.2% year over year. When we come over here and look at the analyst estimates from a revenue perspective, you can see why this company has to continue to acquire brands year after year and actually grow through acquisition, since their organic growth doesn't appear to be impressing Wall Street. Just 2% growth in the upcoming quarter. In fact, we should have earnings very shortly when it comes to VF Corp. They're expecting $3.27 billion. That would be just 2.3% growth rate, which in an inflationary environment where you're seeing apparel like jump 7-8% year over year, that's actually not even beating inflation. They're showing you that they actually don't have a lot of pricing power with a lot of these brands. And then really out over the next year or so, you're looking at just a 2% grower. Somehow you're going to reaccelerate that in the back half of 2023 and into 2024 to get to like a mid-single digits grower on this one. So not very attractive from that sense. But from a valuation perspective, I've got a 10-year price to sales on VF Corp, and you're not going to believe this. It actually hasn't been this low really on record. Okay, you're trading at just 1.3 times sales on VF Corp, and over the last 10 years, it's never been lower than that. I really can't believe that I'm seeing this, and it's making me really interested in the stock. Now, one thing that is making me pause is the fact that this stock, like the rest of these stocks that we're looking at, has really built up a lot of inventory, and their cash and cash equivalents has really been drained. Look at just from March to June. Okay, that's not even year over year. Just from March to June, we went from $1.275 billion worth of cash all the way down to $528 million. Where the heck did it go? It went all the way into inventory. Now, there's likely some build over at this company. I showed you this company's brands. You got JanSport. You've got some other brands that probably sell relatively well heading into kind of a back to school season. So the end of the June quarter, you're building up maybe a little bit of inventory for July and August, which is typically like a back to school season. Look at the inventory build though, just over not even year over year, quarter over quarter, you went from $1.4 billion in inventory, nearly $1 billion higher to $2.34 billion. Last year, you're at just $1.2 billion. So this company more consistently kind of in that billion and a half inventory. Now, all of a sudden, all the way up to $2.4 billion. So Wall Street not expecting a lot of sales growth over at this company. Again, I just showed you the revenue estimates just growing a paltry 2 or 3% over the net, really into infinity with this company. Well, that means a lot of this inventory is going to be marked down and marked down heavily. That will obviously impact profitability, which I'll show you here in a second as well. This company does have some longer term debt, over $4.5 billion. That's a problem because they don't have a lot of cash at the current time as well. And I'll show you they've slipped to an operating loss. So this stock from a price to sales basis, and certainly when we come over here and look at the stock chart as well, is pricing in some really, really rough times, to be honest with you. And now I want to show you the profit and loss statement at VF Corp. So in the most recent quarter, you had that call that $2.3 billion worth of revenue, up fractionally from the year prior when you had about $2.2 billion worth of revenue. Unfortunately, all your costs across the board rose. Your total operating expenses ballooned to $2.2 billion, essentially where you're at from a revenue perspective. Look at your operating income. It went from a $202 million positive operating income this time last year on a quarterly basis, all the way down to just $63 million. And the problem with a company like this, when they don't have much cash, even though interest rates are rising, they're earning a little bit more interest on that cash, but it's basically been depleted almost down to zero in some respects year over year. So you're earning very little interest income. Last year, you earned $2.1 million. This year, just $1.2 million. Look at your interest expense all the way up to $32 million. Now, that is down year over year, but when you earn just $63 million versus $202 million, well, $32 million worth of interest expense is going to obliterate things. Now, they had some other income or an expense here coming in at $94 million. My guess is that's not going to be recurring, but if you take $63 million and then minus off your interest expense, you're at just $30 million with a positive operating income off of over $2 billion worth of sales. That is essentially breaking even. Doesn't leave a lot of margin for error with this company. And certainly when you come down here and look at cash flows, it paints a really, really ugly story. For the last 3 months, you notice that off of that $55 million worth of net income loss, you lost $358 million from an operating cash flow perspective. Last year, you had positive cash flows of $81 million. And again, all of that, in fact, the vast majority of that has to do with the fact over the last year, you built up $961 million worth of inventory. Last year was just $151 million. So when you lose money on a net income perspective, and then you build up inventories at a level this company hasn't, quite frankly, ever seen, that is going to create big, gigantic problems. I tell you what, if you're a fan of any of these brands, guess what? The prices on a lot of this stuff is probably going to be very, very cheap. Now, the stock is pricing it in to a certain degree. This chart, quite frankly, if you viewed the Nike chart early in the video, actually looks a lot like Nike. This stock has been public since 1969. So you're looking at what, like a 50-year chart, and you're looking really at this chart where I've started these two green channel lines. This goes back to 1990. Some of you might not even been born then. This stock has been channeling up, and every time it has touched the bottom of the channel, it has been a buy. And folks, look where VF Corp is today. It is touching the bottom of the channel. The last time it did that was in the depths of the financial crisis and the dot-com bubble. And then you also had an area back here in August of 1990. I'm not old. I was like 8 years old at the time. So I can't tell you from an economic perspective what was going on then, but my guess it was really, really bad. This stock is basically priced in bad things. If you like this stock from a yield perspective, again, you're getting over a 5% yield on this one. This is the area to do it, but you're likely to see a lot more pain with this one. As we went over, the inventory build is likely not going to increase profitability. And the fact that this company is just break even from that standpoint, probably going to put earnings under pressure. But if this company can wade through this time, clean up its balance sheet just a little bit, move through the inventory, well, I tell you what, this is a stock that has proven itself over the last 50 years that just continues to go up. Very interesting stock. We'll keep a very close eye on this one. Very speculative, based on the market cap, based on its sales, based on its financial condition, but it is a company that has proven itself over a very long period of time. Now, finally, probably the most speculative stock that we'll look at, certainly on today's show, but one of the more speculative stocks that we'll look at here on the channel is Under Armour. Now, I have a track record, and I'll show you it here in a second, of analyzing this company very successfully, not over the last year, not over the last 5 years, but we're talking over the last 6 years. I basically called the top in this stock. And I'm here to tell you today that at some point this stock is going to be a screaming buy. And a lot of people wouldn't believe that I would say that. Now, over the last year, stock's been hammered, down 60%. Year to date, down 62%. You have just a $3.6 billion market cap on this one. I remember when it was so much higher than this, when the CEO, Kevin Plank at the time, would literally get on CNBC and talk about his company was going to be better than Nike. And that is when I would do belly laughs and I would actually start to short the stock. Now, I've long stopped shorting this stock as it's had multiple management turnovers. Kevin Plank, who I think is just an idiot. I believe he's still kind of chairman of the board. He's still involved with this company in a deep, deep way. I think he has all the voting rights as well. I think once he completely exits this company, could be a great longer term type investment. But they appointed this Patrick Frisk guy. He was appointed, I think, a couple of years ago. He certainly didn't live up to any kind of expectations, and he stepped down in May. I believe they're still looking looking for a CEO over at Under Armour. I tell you what, maybe give the CEO role to Steph Curry, because I just told you this company has a $3.6 billion market cap, and they're about to give Steph Curry a $1 billion deal. This is likely over the course of Steph Curry's life. And my guess is Steph Curry's not older than maybe 32, 33 years old. So it's a very long contract, and it's over a long period of time. When you see these massive deals, it's not over a short period of time. Allen Iverson, I believe, has a lifetime deal with Reebok, which pays him a lot of money. Several other athletes, I think LeBron James and probably Tiger Woods as well, have these quote unquote lifetime deals with Nike, which see them get paid a large amount of money, which it looks like in the shorter term, but in the longer term, not necessarily that much money. I tell you what, I would just award Steph Curry half the company, and maybe that would help the shares, because again, you got a $3.6 billion market cap on this one, and their top endorser is looking to make $1 billion over the rest of his life. Now, the company just reported their earnings back on August 3rd, and they were relatively dismal. Revenue is just coming in at $1.35 billion. Hey, folks, you ain't going to catch Nike doing that. It was flat year over year. When we come over here and look at the analyst estimates, it's looking a lot like VF Corp, where you're basically just kind of a mid-single digit grower, essentially all the way out into, I see 2025 over at this company, not even eclipsing the $2 billion mark on a quarterly basis anytime over that time frame. But remember, this is like a $3.5 billion company, and most analysts are comfortable with this stock doing north of that when it comes to revenue. So you're actually trading at south of one-time sales on this one. So you are getting still what many people believe to be a premium brand, not necessarily a premium brand, but a notable brand in the athletic market at less than one-time sales. At one time, though, the stock traded a lot higher than that, and I hated this stock. Back on August 1st, 2016, yeah, we're talking about 6 years ago, I wrote an article, probably one of my most popular, and in fact, there was over 240 comments on this article, and it's so funny. If you go back and read the comments, everybody was telling me I was wrong. At the time, this stock was over $39. In fact, at the time of publication, this stock was at $39 per share. And I said they were going to lose the market. They were going to lose a lot of their business. Everybody in the comment told me how stupid I was and how I didn't understand this market and I didn't know what I was talking about. Well, over the last 6 years, the stock is down at 78% and the S&P 500 is up 78%. And certainly if you compare it to a Nike, which I recommended people go into, Nike probably up even greater than that. So I have a track record of predicting Under Armour's demise. In fact, I came back a month or two later, back in November of 2016, and said they made this billion-dollar blunder. And I won't get into it a lot here, but Under Armour invested nearly $1 billion into some fitness apps, and that has led to a gigantic decline in the stocks because they basically invested over like a year's worth of profits at the time into apps that they subsequently had to write down on their financials. That led to steep declines on the stock at the time. This was a $31 stock. Again, it's now closer to $8. I predicted why this was impacted the stock. I predicted how this was a terrible investment. And in fact, this is one of the main reasons why Kevin Plank got the boot, was because he invested over $1 billion in apps when he could have maybe sponsored more athletes. Now, finally, in March of 2020, when the stock was at $9.91, I said Under Armour would not stage a comeback. Now, the stock did rally from $9 all the way up to 18, but it's now back under $7, really closer to $7 per share. The stock is down 25% during this time frame, and the S&P 500 is up 41%. So I have nailed my analysis on Under Armour every step of the way, and I'm here to tell you that things might start changing a little bit when it comes to Under Armour. This wouldn't be a stock that I would invest in more than Nike or even Lulu or probably even VF Corp. But I tell you what, if you're looking for a flyer in the apparel space, this would be one of them, because you've got such a rock bottom valuation. Any type of positive impact on this company, maybe getting a new CEO. I could also see the stock getting bought out. If VF Corp was in a little bit better shape, they maybe could make an offer for this type of stock. You certainly could see other stocks as well, maybe even private equity at some point taking this company private, because you see here, cash and cash equivalents sitting at $1 billion, inventory sitting at $900 million. elevated from the previous period, but not nearly as elevated on a percentage basis as we saw at VF Corp, certainly Lululemon, and even Nike. So they've actually done a nice job, maybe not blowing all of their cash on their inventory. When you look at total current assets at this company, you're sitting at $3 billion. Folks, I'm going to remind you, this is a $3.6 billion company, and they have cash and inventory and accounts receivable at nearly that rate. So you're getting the company for like almost nothing. Yes, they do have some liabilities as well, but nothing egregious, okay? They have about $672 million worth of long-term debt. That certainly could get cleared up. If you look at their total assets, they value them at $4.6 billion. I think we have to discount some of this. Goodwill being at $479 million. Some of these other things you could probably discount a little bit. But I tell you what, it's not that egregious when you factor in total liabilities at just $2.8 billion. Folks, you are getting Under Armour for essentially free. When you factor in their total assets minus their total liabilities, you are getting the core business for almost nothing. And the core business is not that bad, not nearly as bad as it used to be. You had your net revenues come in at $1.35 billion. Again, that's basically flat year over year. The reason why the market isn't paying a big premium for this stock is the fact that you're not growing those revenues. So they got to figure out a way to reaccelerate them. I don't necessarily know how they're going to be doing that. They have terrible marketing over at this company. In fact, all of these companies, we talk about how they're apparel companies, they're actually marketing companies, okay? Because I think we can all agree, if you've owned any Nike product, Nike products don't far exceed any other product. It's just they market their products better than the vast majority of these. Same things goes with like a Rolex watch. You wear a Rolex, it's not any better, certainly any better than like a Patek Philippe or even an AP. Certainly other brands as well out there make probably better watches, but Rolex marketing is better. And that's the missing piece with Under Armour. If they can somehow figure out how to market their products better, well, all of a sudden you could have massive gains in this stock. Because look, the stock is still pretty good. Off of $1.35 billion worth of revenue, we had cost of goods coming in at $718 million, selling general administrative expenses coming in at $595 million. So your income from operations coming in at $34 million. Again, last year far higher at $121 due to the fact that your cost of goods sold and your selling general administrative expenses were considerably lower. So you had higher income from operations. But obviously, if we get on the other side of this inflation thing, well, this company should be able to solve some of their selling expenses, and they should control these cost of goods sold. So we should see if they're able to hold these profits where they're at in this environment. Well, I tell you what, this company probably can come on the other side and start generating these types of profits again, earning just 2 cents per share. But again, in a tough environment, if this company can simply tread water, you are getting this stock at just in a ridiculously cheap price. Now, from a technical perspective, okay, I'm on UAA. There are two different symbols on this one, UA and UAA. I'm not here to tell you which one that you should buy or which one you shouldn't buy, but we're looking at this one. Look, there should be some support for this stock right about where it's at, about $8.30. Again, if you come much lower on this one in a different environment, a VF Corp would come in and try to make a bid on this one. I think you've got a lot of private equity, which could come in on this one, maybe try to figure out, I think the brick wall in terms of this stock getting acquired is Kevin Plank. And so me personally, I'm not 100%. I have like a crush on this stock, but if Kevin Plank were to leave, I would fall in love with this stock. I'd probably almost immediately buy it because he's the brick wall probably keeping this stock back from getting acquired, hiring the right talent, hiring somebody that can actually take over and take the reins on this stock. But it's sitting on a level of support here at $8 per share. I think you could put a stop loss if you wanted to on this one. If you wanted to get into it, kind of a high risk, high reward trade, set it at the 52-week lows or really kind of the 2-year lows down here at about 725. Because folks, if this stock can rebound, you could go from about $8 per share we're talking all the way up on this one, potentially all the way back up, even halfway up this channel would get you nearly a double on the stock price up here at $14, $15, all the way to retest highs that we had last year, all the way up to $23 per share. Again, I'm not necessarily predicting that in the shorter term, but this is a stock that is wildly undervalued at this point. At one point, I called the absolute tippity top with this stock. It was never much higher at one time than $40 per share. I think at one time it got close to $50 per share, but that's actually when I started crafting this article. I called the tippity top in Under Armour, and I'm here today to give you an exclusive. I think we're close to the bitty bottom on this one, whether or not that makes any sense. My sons would probably enjoy it, but I think we're getting close to a bottom on Under Armour from its total asset perspective versus market cap. And it still has some valuable assets when it comes to The Rock, certainly Steph Curry and Tom Brady, and I think Bryce Harper as well. It certainly has some assets under its umbrella. If it starts to clean up some of the mistakes that they made under Kevin Plank, this is a stock that could turn things around. I would, and I caveat all of this, I would take profits on Under Armour. This is not a buy and hold like maybe Lululemon is, certainly VF Corp as well with its dividend, and obviously Nike as well. This would be a stock that I would take quick profits in, and I would have a quick way to get out of this one because it certainly could continue to get worse before it gets better. But I tell you what, based on the valuation, you can't get that much worse when it comes to Under Armour. Hopefully you guys enjoyed today's video. We'll be back again later this week or probably next week as well. We're going to look at the financials. They kick off earnings season coming in about 2 or 3 weeks. So we'll look at the financial sector. I've had requests to look at the energy sector as well. We'll do our best to cover some of those stocks. And obviously when we head into the last week of next month, you start to see the Amazons and the Apples and the Microsofts. We'll do individual preview videos on the vast majority of those stocks as well, as obviously this earnings season very much watched by the market. Hopefully, guys, have a wonderful day out there. We'll be back again soon with more. Good luck with your investments.